The market bled today. Washington is playing games with your money, and the one bill that could change everything just hit another wall. Welcome back to Crypto Insight Hub, the channel where we break down what actually matters in crypto every single day. Let's start with the numbers because they are not pretty. As of today, Friday, March 6th, the total global crypto market capitalization has dropped back down to around $2.48 trillion, a 2% decline after what looked like a promising short-term recovery earlier in the week. Bitcoin is sitting at roughly $71,000, down nearly 2 to 3% on the day. Ethereum is holding around $2,075, also down about 2%. And it isn't just the majors either. Solana is down over 2.5%, XRP has shed more than 2%, and BNB is following the rest of the market lower. Dogecoin is leading the decliners today, dropping over 3.5%. Essentially, everything is red. Now let's put that in context, because this drop isn't coming out of nowhere. Earlier this week, the market pumped hard, nearly 5.5% in a single day, on what many believed was fresh buying momentum. But analysts quickly pointed out that the rally was not built on solid ground. It was largely driven by short covering, meaning traders who had bet against the market were forced to close those positions when prices ticked up, creating a mechanical price spike rather than genuine demand. Open interest rose sharply while spot buying did not follow, which is typically a warning sign. And sure enough, the bounce has faded. Today's drop is essentially the market exhaling. What's making things worse is sentiment. The Crypto Fear and Greed Index has fallen 4 additional points today, landing at just 18, deep in extreme fear territory. To put that in perspective, a reading of 18 means the overwhelming majority of market participants right now are scared. They're not buying. They're either selling, sitting on their hands, or waiting to see what happens next. This level of fear has historically preceded some of the most significant reversals in crypto history, but it has also marked the beginning of extended downtrends, so nobody is celebrating just yet. The liquidation data is brutal too. In the past 24 hours, over $252 million worth of positions were wiped out across leveraged markets. Of that, nearly $167 million came from long positions, traders who were betting prices would go up. The market punished that optimism today. So what is actually driving people out? The answer lies in Washington.
This is the big story right now, and it broke today. The Clarity Act, formerly known as the Digital Asset Market Clarity Act, is the most significant piece of crypto legislation ever proposed in the United States. It passed the House of Representatives back in July of last year with an overwhelming bipartisan vote of 294 to 134. That was a huge moment. For the first time in crypto's history, lawmakers were moving serious legislation with real teeth. The bill would end the long-running jurisdictional war between the SEC and the CFTC over digital assets, formally classify most major cryptocurrencies as commodities under CFTC oversight, create legal clarity for crypto exchanges and custodians, and pave the way for massive institutional capital to flow into the space. But it has to pass the Senate, and the Senate has been a mess. The first big delay came in January, when the Senate Banking Committee's markup was postponed after industry players withdrew support over contentious amendments, including one that would have effectively banned yield on stablecoins. Then came a self-imposed White House deadline of March 1st for banks and crypto firms to resolve the stablecoin yield dispute. That deadline passed without a deal. And now, today, new reporting confirms that the Clarity Act has hit yet another fresh roadblock. Banks are still not backing the compromise that the White House has been pushing. The central fight is this. Banks like JP Morgan, Bank of America, and Wells Fargo are deeply opposed to allowing stablecoins to pay yield to holders. They argue, and this is not an unreasonable argument, that if people can hold digital dollars that earn interest on platforms like Coinbase, money will flow out of bank deposits on a massive scale. Bank of America's CEO has reportedly warned that we could see trillions of dollars migrate out of the traditional banking system. Crypto firms, on the other hand, say that banning stablecoin yield would crush innovation and drive the next generation of financial infrastructure offshore. The Senate Banking Committee is now eyeing a mid to late March window for a second markup attempt. Whether that happens depends entirely on whether this stablecoin yield fight can be resolved. Here's the stakes. Prediction markets on Polymarket currently price the odds of the Clarity Act being signed into law in 2026 at around 74%. Ripple CEO Brad Garlinghouse has publicly put the odds even higher at 80 to 90% and says he expects passage by late April. JP Morgan analysts have described the Clarity Act passage as a positive catalyst for digital assets, pointing to regulatory clarity, institutional scaling, and tokenization growth as key drivers. Treasury Secretary Scott Bessent has called for a spring signing target, signaling that the White House views this as genuinely urgent. But here's the catch. If the bill doesn't pass before the November 2026 midterm elections, it could die in committee and get pushed to the next Congress. That would mean waiting potentially until 2027 or 2028 for clarity. Years of continued regulatory limbo. And the market knows this. The Fear-Greed Index reading of 18 today is not just about price. It is about this uncertainty. Investors don't like not knowing the rules. Cardano founder Charles Hoskinson has been vocal as well, though from a different angle. He's actually been blasting the Clarity Act itself, calling it a, quote, horrific trash bill, and warning that the way the legislation is structured could classify most new crypto tokens as securities by default, which would expand SEC authority over emerging blockchain projects and potentially stifle innovation rather than enable it. So you have banks opposing it from one direction, some crypto industry voices opposing it from another, and the clock is ticking. In other regulatory news today, the SEC has dropped its lawsuit against Justin Sun, the founder of Tron, settling for $10 million through his company Rainberry, formerly known as BitTorrent. This is a significant moment. The original charges from the SEC were substantial. They included allegations of market manipulation, the orchestration of wash trading on secondary markets, and unlawfully touting of securities by paying celebrities to promote TRX and BTT tokens without proper disclosures. The settlement closes a chapter on one of the more high-profile crypto enforcement cases of the last few years. Whether you see this as a win for Sun or a sign that the new SEC under Chair Paul Atkins is winding down the old enforcement regime, it's worth noting that $10 million is a fraction of what many expected the final penalty to be. Under former chair Gary Gensler, the SEC launched over 100 enforcement actions against crypto companies. The tone under Atkins has been dramatically different, focused more on rulemaking, taxonomy building, and enabling compliance pathways rather than prosecuting first and asking questions later. One other development worth discussing today. The SEC, the CFTC, and Federal Reserve have been increasingly coordinating through a joint initiative called Project Crypto. In January, the SEC released a statement laying out a formal taxonomy for tokenized securities, defining how assets that are tokenized on a blockchain still retain their legal classification as securities. It might sound technical, but it matters enormously. Why? Because it clears the path for the next phase of institutional adoption. The depository trust company, the infrastructure backbone of U.S. securities markets, received a no-action letter from the SEC to run a 3-year pilot program tokenizing custodied assets on blockchain rails. We're talking about Russell 1000 stocks, major index ETFs, and U.S. Treasury bills being placed on-chain. The DTC aims to launch this pilot in the second half of 2026. This is not fringe crypto stuff. This is Wall Street's central clearinghouse experimenting with blockchain technology. It is a massive signal.
Meanwhile, the Federal Reserve has announced plans to create what it calls skinny master accounts, a pathway for crypto-native financial institutions to get direct access to the Fed's payment infrastructure. The Fed wants these available by the fourth quarter of 2026. Governor Waller put it plainly in a recent speech: distributed ledgers and crypto assets are no longer on the fringes. They are woven into the fabric of the financial system now. On the altcoin side, a token called WAR is topping the trending charts today, driven by a massive spike in social engagement and trading volume. Pi Network continues to draw attention from its growing community as mainnet developments capture interest. OKB from the OKX exchange is trending on the back of new utility features and ecosystem expansion. And a token called Kite has exploded nearly 30% in the past 24 hours, which is the kind of move that always warrants caution. Sharp single-day spikes like this are often followed by equally sharp reversals. Let's zoom out for a second. The crypto market in early March 2026 is in an uncomfortable place. Bitcoin peaked above $126,000 last October, then slid all the way back to the low 80s by November, and has been grinding through a choppy period ever since, currently hovering around 71,000. The Fear and Greed Index today at 18 tells you this has been a psychologically exhausting few months for a lot of people. But here's the thing. The macro backdrop is not actually bad. The Federal Reserve is set to announce its next interest rate decision on March 18th, less than 2 weeks away. After easing liquidity tightening in late 2025, markets are watching closely for any signals on rate cuts. In past cycles, looser financial conditions have been a strong tailwind for crypto. If the Fed delivers even mildly dovish language on the 18th, we could see a significant sentiment shift. And the institutional infrastructure being built right now is genuinely historic. Bitcoin ETFs now hold roughly 7% of all Bitcoin in existence. BlackRock's Bitcoin ETF has become the firm's top revenue source, with allocations approaching $100 billion. Morgan Stanley has filed for both a Bitcoin and Solana ETF of its own. Bank of America is allowing all 15,000 of its wealth advisors to recommend spot Bitcoin ETF allocations to clients. Goldman Sachs says 71% of institutional asset managers plan to increase their crypto exposure over the next 12 months. The fundamentals are being built. The regulatory framework, despite today's frustrating delays, is closer to existence than it has ever been. The adoption curve among major financial institutions is steeper than most retail investors appreciate. Does that mean prices go up tomorrow? No, the market is scared right now. The Clarity Act drama is weighing heavily. The short-term picture is cloudy, but zooming out, the direction of travel is still very clear. That's going to wrap it up for today's Crypto Insight Hub update. If you found this valuable, please hit that like button. It genuinely helps this channel grow and helps us keep bringing you this content every single day. And make sure you're subscribed so you never miss a video. Drop your thoughts in the comments. Are you buying this dip, or are you staying on the sidelines while the Clarity Act drama plays out? I want to hear from you. Stay sharp, stay informed, and we'll see you tomorrow.